Hi guys. Okay, let's talk about the UUU energy fuels trade we talked about on Friday on last week's WTW. We are August 18th on a Monday, okay, and that's UUU trading in a consolidation type pattern after a big move up, and I expressed my interest in buying UUU as a proxy play to the MP materials, the rare earths move that is going on in the States. The U.S., of course, is going to try to onshore rare earth development onto the U.S. So this is why MP has had a bid, and this is why I think UUU is a good proxy play to this rare earth game, because it has rare earths. It's the second biggest company in the States that, well, you can buy it and you will have rare earth exposure, even though it's a uranium play. So you're getting the rare earth exposure plus the uranium move. So maybe UUU will also get a favorable government contract in the future based on this rare earth thing. Okay. Now we've established that we want to buy it, and we mentioned that we wanted to initiate the buy with an option structure. Okay, so how do we structure this trade so that we get the best risk reward, best bang for our buck? Okay, this is the tough part. Okay, so as I mentioned before, maybe it wasn't that clear, but last week I mentioned that I wanted to buy a call spread and finance it with a put by selling a put spread. Okay, and that specifically means I wanted to buy one call at the $10 level and sell a call at the $15 level. Okay, and to finance this, you can just, there's many ways to do it. You can just do this, okay, and it'll cost you about $1, and the risk reward is 10 to 5. It's 5 to 1, because you can potentially make $5 if UUU spikes to 15, or you can lose your $1. So it's 1 to 5 risk reward ratio. Okay, but the odds of it getting to 15 are very low. So you're not exactly going to make 5 to 1 if it happens. More than likely, maybe 2 to 1, 3 to 1 if you're lucky. Okay, so in order to finance this, instead of paying $1, I wanted to sell 2 puts at the 8, and then maybe buy back those 2 puts at the $6 level. Okay, because that's like a 20% drop from the price right now, which is $9.66. Going from $9.66 to $8 is like a big move, and then going back to 6 is even bigger move. So if this costs $1, this should cost about $1 to offset it. Okay, so will it? Let's see. So let's go to our options tree. I have it set up here, UUU put call ratios. I'm looking at the October expiry, which gives us 2 months to have this trade play out, with plenty of time. Okay, and we look, these are the calls. In case you're not familiar with option trees, these are the calls and these are the puts. Okay, and you have the strike prices going down here, all the way down here. Okay, I've also included important stuff are the bid-ask spreads, of course, and the delta. We'll get to the delta and what that means later on, but it's important in setting up our trade structure and how we go about doing it. Okay, so we were interested in buying the $10 call. I'm assuming worst case scenario, so we buy it at the ask. So we're going to start building our strategy builder here. We bought the 10 calls, and we're going to sell the 15s. Okay, as you can see here, we buy the October 17 strike price 10 calls between 115 and 120, and here we are selling one contract, buying one contract, selling a contract of the 15 calls, and we're going to sell it for 20 cents. So here is the debit, the cost to this part of the strategy. It's going to be 85 cents to $1, depending on what price you get. So for us, it'll be the worst case scenario, 85 cents, let's say. Or excuse me, $1. We'll be paying $1 to get that. Like buying it at 120, selling it at 20 is $1. Okay. But we also want to offset that by going into the put section, the 8 put, and we're going to sell that. We said we're going to sell the $8 put, and then finance it with a 6 put at 15 cents. Okay, now we'll see how that works. And we said it will be a 2-to-1 ratio, so instead of 1 contract, it'll be 2. And this one, 2. So the put spread, so this is going to give us a credit of 5 cents, or we're going to pay 40 cents for it. Okay, so probably the midpoint will probably get 45, 20. It'll probably cost us around 15, 20 cents to implement this whole strategy, okay, depending on what prices we get. We're not going to put it at 40 cents, that's too much. So we're going to probably go around 10 cents. We're going to put our bid around 10 cents. So we're paying about 10 cents, okay, to have this whole strategy in place. Now, why are we doing this, okay? We are doing this instead of paying $1 to lower the costs, okay? And to show you that that it's important to play the odds in your favor when you are doing option strategy, okay? Because if we just did the call spread, okay, you will see that this delta column tells you, okay, if people are not familiar with delta, delta is the change in the option price versus the change in the underlying security, UUU, okay? So it's telling you here that, let's say we look at the $10 call, delta is 0.53. It's telling you that for every dollar move at $10, for every dollar move in the underlying security, that call will go up by 53 cents. Okay, so if this goes to $11, this call will go to 173, okay? So if it goes to $11, this call option will go from 120 to 173 on the ask. Okay, so that's how it works. It tells you how it moves, how the price of the option moves vis-a-vis the stock price. However, it's the same for the puts, except there's a minus in front, which just means that puts move in the opposite direction. Like if the price goes up, the put value will go down, and vice versa. Okay, so this also conserved, though. Delta is also a proxy for the percent probability that your option will be in the money or at the money, let's say, when it expires in October. So in 2 months, there's like a 53% chance that the price will be at $10. About, it's not 100%, but it's around that. So you can look at it as a chance of success in this option strategy. Now, deltas change with the passage as the price of the underlying changes, so does the delta. Okay, so they are not static. However, we can use it as an approximation right now, given all things happening right now. We know that there's a 53% chance that this $10 gets hit, or the price will be at $10 in 2 months. 53% chance. Okay. So commensurately, if we look at the $15 call, we can see that the delta is 15.15 cents, so 16. So there's a 16% chance that in 2 months, this call option, the price of the underlying will go to $15, okay, which is very, very low. Okay, this is why you don't want to if you just bought the $15 call thinking that you're going to make money and there's going to be a rip, you're only going to have like a 16% chance of making money. Okay, so and somewhere in the middle, like between 15 and 10, you can see the percentage chances of it closing at 13 in October is 25% chance. So it's very low chance for you making money. Okay, so it's about an even chance for it to go above $10. You have 50, flip a coin, slightly better than you making money if you just bought the $10 call. Okay, but that would have cost you $1.20. So we're mitigating this by selling this call option. Okay, so the deltas tell you pretty much the move in the option vis-a-vis a commensurate move in the underlying stock. However, they change over time. Okay, constantly. Okay, so there's also something called gamma, which is a second order change, which is like a little bit too complicated to explain. but think of delta as technically the first derivative change of the underlying, and gamma is the second derivative change. But that's too complicated to understand. All you have to know is that there's a 53% chance of it going above 10 in 2 months, and a 16% chance of it hitting 15 in 2 months. Okay, so in order to make this strategy worthwhile, we have to put the odds in our favor. Okay, and the fact, like, you can say the same logic applies when we're talking about puts. Okay, so with a put, this $8 put has a, as we see that the delta is 22, so it has a 78% chance of closing above 8. So it only has a 22% chance of going down to $8 as things stand right now. So, like, by selling the $8, we are pretty much like saying that the $8 put, we're pretty much saying that we have a 78% chance of success, that selling that option will expire worthless. Okay, so we sold it at 45 cents. That means there is a 78% chance that that expires worthless, and we keep that 45 cents. Okay, same thing with, look at this $6 put. There is literally, the delta is like 7. So there's like a 93% chance that the 6s never get hit. Okay, but that's why it's trading at 5 to 15 cents, almost nothing. Okay, so here, this whole strategy altogether is going to basically cost us maybe 10 cents. Maybe the midpoint, 15 cents, let's say, was 45.20. So let's say 15 cents if we were to enter it at midpoint. So it would cost us 15 cents instead of $1 to try to play UUU long. Okay, because this is a long strategy. This is long, and shorting puts is long. Okay, this $6 call put that we buy is to protect us if the price ever goes below that. Okay, and we did it in a 1-for-2 ratio. So for every 1 share that we buy with this speculative call option spread, we are selling 2 of the puts here. Okay, the risk is that it does for us here, since it's going to cost us, let's say, 10 cents, 15 cents max. Okay, it's almost nothing. It's a very small debit that we pay. The risk is that if the price goes below $8, we have 2 options that we sold here. So let's say we did 1,000 shares here, we did 2,000 shares here. We're going to be short, long 2,000 shares at $8, and if it goes to 7, that means we're losing $1 for 2,000 shares. So we're down $2,000 if it goes to 7. If it goes to 6, we're down $4,000. Okay, so that's where the danger is. So you have to measure your risk based on this, the put side of the equation, not the call side of the equation. Okay, because if you just did the calls, your risk will be $1.20. You know that for sure. But for this, our risk now, because it's going to cost us about 10, 15 cents, our risk now could be more than $1. It could be $1 because we're double the rate. So it could be $1 or $2. So you have to understand that if you do 2,000 shares, your risk, your maximum loss here could be $4,000 if it goes down to 2, because you protected yourself by buying the $6 put. Okay. So all this is going to cost us, let's say, 15 cents, 20 cents to do. However, we could mitigate this cost by getting rid of this, buying this call, the $6 call. It's so unlikely it's like a 7% chance it's going to hit. It's so unlikely that it'll happen that we could eliminate this leg of the game, of this structure. Okay, and you can see now that the cost has dropped from, what was it? From -5 to 25 cents, which is probably get the midpoint. No, we have to put this as a 2. So it was 0 to, so now it's probably going to cost us 20 cents at midpoint, this strategy, because things are moving as I'm writing. So this is going to cost 20 cents now instead of 15, let's say. Okay, because we have this, we had to buy this protective put. But if we don't buy this protective put, and we just do 1 on this spread and 2 naked puts, now we can get it for 0 if we get the midpoint. -10 credit or 10 cent debit. We can do the whole thing right now for 10 cents debit, but probably get it for 0. So we can do this whole strategy risk-free, not risk-free, but costing zero. And we're just open to the upside here, and we have to mitigate the loss that we might get for here. So if you ever do get assigned these 2,000 shares, you would have to punch out manually at 6 to replicate buying this put. Okay, but the fact that you don't have this protective put makes this less costly of a structure. So you have to ask yourself, how do you want to play it? Do I want to play it this way, where I'm naked short, but it costs me nothing to enter this? Or do I want to put the protective put here and guarantee just a $2 loss? Okay, because this could go below 6, it could go to 5, 4, 3. We've seen UUU, like if you look at the chart. We've seen UUU, at 4 or 5, But now I'm betting that it doesn't happen because we have fundamental news to support it. Okay, so the 1-1-2 structure is a safer way to play it, putting the odds in your favor, because remember, we're playing the odds here. Okay, there's literally 22% chance that it gets down to $8 and a 6-7% chance that it gets down to 6. So I'm going to take that chance. For me, I put it in like this. I put in this trade going long and just naked short. So I'm happy with that. I can mitigate it myself. I didn't go too heavy. I know exactly what my risk is, and I will punch out manually on the $6 if it ever gets there. So I know exactly what to do on the risk side. And my upside is going to be $5 max. Okay. Doesn't have to be. If it expires within here, I might just hold the shares, and it could go even higher. So there's plenty of options that you could do with this trade. So it fits exactly the parameters that I want, i.e. being long UUU, costing almost nothing. It's going to cost me 0 overall. And all I have to do is watch out for the risk if it ever goes down to $6. Okay, so this trade structure now is done. Like, let's get rid of this to show you guys exactly. How do I get rid of it? Anyways, you know that this part right here is nixed. Okay, I chose to do that. You don't have to. If you want to sleep at night, you can just pay the 15 cents to have that. Although it'll cost you now a 20-cent debit to enter this whole thing. But for me, I wanted to do it at flat costs, so it'll be pure profit if it ever goes up here. Okay, and if it ever goes down here, I'm going to be assigned at $8, which is fine with me. I'll take it. Okay, and I'll mitigate it after the fact. There's so many ways you can play it, but this, to make it, I just wanted to go over the UUU trade and why I wanted to do it in this option structure, because it mitigates the risk more than had I just bought the shares outright at this juncture. However, if I bought the shares outright, you can make way more money, but you can also lose way more money. It's like a 1-for-1 risk reward. Okay, here it's a little bit better because the odds are in my favor. Very low chance that it even gets to $8, which is like a 22% chance it gets there. Whereas here you're like flipping a coin 50-50. Which way goes up, which way goes down, I don't know. So this is how I chose to structure my UUU trade, which is a proxy for the rare earth element trade in the US. Thanks, guys.